My name is Vladislav Sitnikov, and I'm regional manager for a EMEA region in a global US bank, mostly working on treasury and wealth management activities. And I want to welcome everyone to our panel discussion. Today we have gathered esteemed finance professionals with diverse backgrounds and expertise to shed light on the various aspects of liquidity management and its significance in navigating challenging economic conditions. Our distinguished panelists include Adrian Toska, the Regional Finance Director at Medicover, Julia Fodor, the Director of Treasury Department, CEE Center and Bank of China, Hungarian branch, and Laura Elena Simeonescu, the Head of Finance at Global Treasury, British American Tobacco. Throughout our discussion, we will delve into the impact of the global regulatory landscape on companies' ability to manage liquidity effectively. We will explore the challenges and opportunities presented by stress testing for liquidity and recovery and resolution planning. Additionally, we will delve into the strategies that treasurers employ to manage interest rate risk and optimize liquidity, as well as examine the influence of geopolitical and macroeconomic developments on corporate liquidity. With our panelists' diverse perspective and insights, we aim to provide you with valuable knowledge and practical strategies to optimize liquidity in such times of economic slowdown. So let's begin this engaging, informative discussion on liquidity optimization. And Laura, how does the current global regulatory landscape impact companies' overall liquidity management strategies and their ability to navigate economic slowdowns?
Hello, everyone. I hope you can hear me. To answer your question, Vladislav, I think regulatory landscape significantly influences liquidity management strategies. Market turbulences and times of economic slowdown can create a domino effect on the economy. So regulations play a key role in one, maintaining adequate liquidity in the market, and two, containing any disruption. For example, in 2020, when the virus in China started to spread, the liquidity instantly dried out for a couple of months before the regulators intervened. At that time, we were funding ourselves in the market, and we started to see signs of deteriorating liquidity. So we started to put scenarios in place. Some corporates even had their RCF drawn, their loan, just to be on the safe side, thus increasing pressure on banks. As expected, regulators injected liquidity in the economy, and whilst the crises were still there, the liquidity did improve. And more recently, when signs of distressed banks started to show up, it was more important than ever that the crisis had to be contained fast. And we did notice speed in decisions to achieve this. Having said that, it's crucial for the regulators to be properly balanced so that they achieve the main goal, which is to promote financial stability. Too tight regulations could have the opposite effect, restricting credit availability and limiting liquidity support. So in summary, regulations can have a significant impact on economy. The right balance is needed to achieve financial stability, which is their ultimate goal.
Thank you, Laura. Your insights have been enlightening. Now let's hear from our next speaker, Adrian.
Yeah, so hi everyone. I hope you can hear me well. Yeah, continuing in Laura's perspective, I do believe that the regulator's main goal is to give a bit of perspective on the market and to put a bit of confidence all across. So Laura was mentioning about the injection of liquidity in the last couple of years. Yes, we saw it. Some of us were really taking advantage of it. Now we are seeing the other type of movement happening. I think we are now in a quantitative tightening period. So from my perspective, regulators should be the ones that really are calming down the macros, the companies, and for sure they are really able to influence what the businesses are doing. For example, now I think with the new rules in place, with the, let's say, much more tightened conditions, companies are much more are paying much more attention on how they are deploying the capital. So yeah, for sure, regulators and rules are really critical factors for managing our businesses today.
Thank you, Adrian. Highly appreciate it. Yulia?
Yes, good morning, everyone. So I'm representing here a sector for who liquidity management is really the core business. And as such, we are pretty strictly regulated. So there is a European framework called the ILAP, which stands for Internal Liquidity Adequacy Assessment Process. And actually, this framework proved to be very efficient in the past difficult times to navigate through the difficulties in liquidity management. So the number one pillar of this concept is the liquidity coverage ratio, which requires banks to maintain sufficient high liquid assets to survive 30 days under stress scenarios specified by authorities. Another important EU requirement is to have a net stable funding ratio, which is naturally the available stable funding divided by the required stable funding. So this is basically the European concept. When we go a bit west, actually the UK jurisdiction is a bit stricter. So besides the Pillar 1 requirements, they also require Pillar 2 liquidity, which contain the elements not covered by the Pillar 1 requirements, such as intraday liquidity or debt buybacks or non-margined derivative trades. And on the other side of the regulations, we can find the US jurisdiction, which is a bit lighter than the European. So, for instance, the small financial institutions are exempted from the LCR requirements. And actually, we have seen in the recent past some bank failures, partially because of the non-existence of these requirements and because they did not respect these requirements, such as the Silicon Valley Bank or the First Republic Bank or Signature Bank. And actually, I expect that regulators may impose further requirements on the back of these US bank failures. So maybe they will extend the UK Pillar 2 requirements to European banks as well, or to impose some shorter dated liquidity coverage ratios, for example, 7-day LCRs, which actually I personally recommend to implement regardless of whether there is a regulatory requirement to keep that or not, because after all, I think it is not the supervisors, but each bank's own responsibility to maintain a stable operation.
Thank you, Yulia. Next, dear panelists, please share your experience. What roles does effective liquidity management play in ensuring financial stability and resilience for companies in uncertain economic times? Maybe we can start with you, Adrian.
Yeah, can you just please repeat a bit the question? Sorry, I had some issues with my headphones.
Yeah, sure. In your experience, what role does effective liquidity management play in ensuring financial stability and resilience for companies in uncertain economic times?
Yeah, sure. Thank you. Yeah, it's really crucial, and I will get back to 2020 when suddenly we have a part of our business is a kind of a retail business. So we are face to face with our customer, and suddenly from one day to the other, our business dropped to 10% from what it used to be. And we were looking into our bank accounts and say we had that X amount, and we were monitoring it on a daily basis. We were planning it like we never did before. So these uncertain times really made us better in monitoring, made us better in assessing the needs, made us better in quantifying much better our cash flows. So I think for us, and not only for us, for the whole industry, this was a really good lesson in really monitoring much better our liquidity and deploying it to really good projects. Other lessons that we've learned is that we should really leverage much better the available technology in order to better monitor and faster and have like much more in a real-time analysis of our liquidity. Speaking from a person that is supervising a region, sometimes the lack of some proper systems might get you a bit in trouble, not having the full info ready, available, and live. So yeah, a good let's say some really good learnings that we had from the last couple of years.
Thank you, Adrian, for sharing your great experience. Now let's proceed with our next speaker for further perspectives. Julia, what is your view on this? What is your experience?
Yeah, so I think that stability and resilience is really of utmost importance in turbulent times. Investors have a tendency to have a preference for stability over high yields in this environment. And so when it comes to banks, I think that the banking business is really about maturity transformation. And so in a traditional banking model, banks fund themselves, actually their long-term loans from shorter dated deposits. And I think this is really traditional banking. And I think these types of risk can be bared by the banks easily. But I would also come back to the recent US bank failures. So while I think it is okay to have unhedged exposures in the customer loan portfolio of a commercial bank, these banks had over 50% of their exposures, of these exposures in the liquid bond portfolio, which is, for the least to say, unusual and very far from being prudent. It might be okay for a traditional investment bank, but for commercial banks, this is really not, I think, the proper approach. And yes, we all understand that maintaining a higher liquidity buffer may not be the most appealing tool to ensure proper liquidity, because this is eating up our margin. But one needs to admit that on one hand, in turbulent times, it's necessary in some extent. And the other thing is that there are other powerful liquidity management tools that one may consider for the purpose of ensuring stability. We can diversify on our funding base. And actually in the UK, this is a pillar 2 requirement, not to have a high concentration. Or we can reduce our surplus liabilities by increasing customer business. So this is also a very natural tool to increase liquidity. And even we can implement a more accurate management reporting system, so that can also help to be more efficient in liquidity management. So I think these actions could all improve resilience without hurting our earnings.
Thank you, Julia. Laura, could you please share your experience on this?
Sure. I mean, I totally agree with both Adrian's and Julia's perspectives. Crises were not just planned for, unfortunately, the crisis management, but we had to live them. And the liquidity management is always high on a treasurer's agenda, but in times of uncertainty, adequately managing liquidity becomes critical. It's about ensuring there is sufficient cash available to meet financial obligations, to make sure, I mean, in uncertain economic times, the business is under pressure. Volumes are down, collections may be down. By maintaining sufficient liquidity, companies can avoid defaulting on payments. Maintaining credit worthiness is about maintaining business continuity and preserving reputation. So yeah, by prioritizing liquidity management, companies can position themselves to navigate economic uncertainties, to sustain operations, and emerge stronger throughout the crisis.
Thank you, Laura. And, we already have one question from the chat. Maybe let's respond to it before we will move next. The question is, did you have any experience with automated funding capabilities? Anyone wants to share your experience on this?
Automating funding capabilities in term, do you mean like tools that can automatically provide funding? I think the market is not there from my perspective, at least. If I'm missing anything, just let us know. We have seen providers that are starting to try to create a sort of automated platform in commercial paper area, which is lagging compared to FX, for example, where we trade hundreds of billions yearly. In commercial paper, and everything is automated. In commercial paper and in funding, everything is more manual. We have seen steps towards automation, but I guess because this market is about putting face-to-face investors and sellers of papers, the pricing needs to match at some point, and there's a lot of discretionary and negotiation in that element, which is why it makes it a little bit more difficult.
Thank you, Laura. And now I want to discuss about stress testing for liquidity and recovery and resolution planning. Julia, how do companies approach stress testing for liquidity, and what methodologies or models do they employ to identify potential vulnerabilities and risks?
Okay, so I would not aim to reinvent the wheel here. So I would rather take the UK regulatory guidelines as a basis and just add some comments on some of its elements. So first of all, they require stress tests to address severe but plausible scenarios. They also require to focus on just key vulnerabilities. And it also makes sense that they require to perform stress tests on a regular basis. So I think monthly stress scenarios is definitely something that one shall meet. And they also have some guidelines on what types of shocks we have to stress. We have to stress for unforeseen name-specific stresses, so those stresses that are specific for the firm itself. Also for market-wide stresses, and also for macroeconomic stresses. So there is a supervisory statement number 24/15, and it has a list of 14 elements which shall be included in the stress test. So I would pick up a few which I think are particularly interesting in the current environment. So one of them is that actually regulators expect a runoff factor on retail and small and medium enterprises deposits to be between 3 and 10%, while this runoff factor is 100% on wholesale deposits. This is because they consider that retail deposits are much more stable than wholesale deposits, because large corporates and financial institutions are pretty much well covered with banks, so they can move their deposits from one day to another for a higher interest rate. But I think, in my opinion, and taking into consideration what happened to Silicon Valley Bank, where $40 billion were moved out of the bank within 48 hours. So if you calculate that, that's $1 billion per hour. So I think the retail runoff factor is worth to be revisited in each financial institution. The other one is the correlation and the concentration of funding. So in the previous question, I already mentioned the importance of diversifying the funding pool. I would just like to reemphasize here. And the funding tenors. So here, there's not much detail about the funding tenor in the guideline, but one thing I think people should think about is that the behavior tenor does not equal the contractual tenor for deposits. So because of possibility of breaking the deposits or rolling them over, very often the contractual maturity of the deposit is very different from the behavior of the deposit. And the last element I think I would like to mention is the intraday risk, which is gaining more and more importance because of the instant payment systems established. So in Hungary, the instant payment system is already here and mandatory for transfers below 10 million HUF. So the transfer shall be made within seconds, and the European Union is also considering establishing the instant payment system in the Eurozone as well. So all in all, I think that the PRA scenarios provide a fairly comprehensive coverage of all the possible directions from which a stress may arise. What one needs to really think over is how these assumptions translate to their own firm's characteristics.
Thank you, Julia, for your insights. I believe it provides valuable lessons for our audience. Adrian,
yeah,
what do you think?
So yeah, I'll try to move from a non-banking perspective and to share a bit my let's say my business perspective. So we are running a business which is having two main components. We have a B2B and a B2C segments, and what we did lately in order to assess much better our liquidity position, how we the scenarios that we faced, we split much let's say thoroughly our portfolio per industries, per different type of segmentations, in order to match a bit the current macro environment. To give you some examples, in some of our geographies in B2B, we are exposed to sectors that are suffering a bit. So we are constantly looking to shift or to balance our portfolio in such a way that the future cash inflows are not affected. B2C wise, we are also trying to balance it a bit more, because in some other geographies where B2C was really strong, where we had like very good cash collection, so it was like zero creditor base, so we were just collecting directly from our customer on a retail basis. When the pandemic hit us, suddenly we lost that let's say most profitable and most cash generating unit of our business. So what we are trying to achieve now from a stress testing perspective is to balance our portfolio as much as possible in order to provide the business with the necessary liquidity that we need. I won't go onto the treasury side of the business necessarily. I wanted to touch base more on the let's say purely operational aspects that we are trying to have in order to keep us really safe, because having also some let's say strong exposure on so we're having a pretty sizable net debt to EBITDA ratio now, so we have some things to watch out, and we really need to be really prudent not to bypass some gearing ratios, and that's why we are always monitoring and trying to balance our portfolio.
Thank you, Adrian. Definitely that's a different perspective, different angle to our discussion. Thank you. Laura?
From our perspective, we should be stressing both sources and uses. This is what I would add to what my colleagues have mentioned. When it comes to uses, we should project cash flows on various horizons. We have a daily short-term cash flow forecast and a monthly mid-term cash flow forecast, and we balance the long-term liquidity need and the short-term liquidity need. We should also stress the projections and, as Adrian was mentioning, and conservatively incorporate any sensitivities. But also when it comes to sources, we should assess the reliability of each source. As I mentioned, we've witnessed the dry out in the CP market, so that tends to be considered as you can't really count on it in a stressed scenario, so you have to be prepared. We've put alternatives in place. For example, we have committed bilateral loans on top of the committed RCF facility, which acts as a safety net. It's important that the sources of funding are diversified in terms of currency, geography, duration. And lastly, we should match, as I said, long-term gaps with long-term debt, short-term gaps with short-term debt. We also have certain metrics. For example, we do not want more than a certain amount of debt to mature in a certain year. These would be few recommendations I'd make to make sure vulnerabilities are properly assessed.
Thank you, Laura. Next, I want to discuss what are about hedging or the diversification strategies, how to manage interest rate risk in particular. So what are the main strategies or instruments that treasurers can employ to hedge against interest rate risk and optimize liquidity management with the current interest rate environment? Adrian?
Yeah, so I will try to be short on this one because my fellow panelists are much more experienced in this area. So what I'm so for sure you have the usual let's say hedging tools like forward contracts, swaps, and all these tools that are available on the market. What I've seen lately as a trend, and maybe my colleagues can confirm or not, is kind of a switch in many companies from a variable interest rate exposure to a fixed rate on a relatively short term. So, but again, depends a lot on the risk appetite of each company. So I have colleagues that they are just not hedging. So I think it's such a matter of option. I'm not from the banking industry, but yeah, probably we had some learnings during the last couple of months about not properly hedging or not properly managing the risk in your portfolio. So yeah, in summary, I don't want to keep the time from the real specialists on this topic. So yeah, that would be from my side. Thank you.
Thank you, Adrian. Julia, how do you hedge interest rate risk?
Yeah, so usually I provide lots of advice on that for corporates, but I think in this panel, Laura can give more insight on from her perspective on how corporates tackle this. So I would stay with how banks tackle this question from the banking book's perspective. So actually, interest rate changes are really a factor that banks are directly linked to. So they have to be very conscious about how a yield curve change affects their business. And to be honest, the current stagflation setting with inverted yield curves is not an easy one. So when we see inverted yield curves, it always signals that there are instabilities on the market. And with the stagflation setting, there are vivid conversations among monetary policy makers about whether they should continue tightening to fight inflation, or if they should worry more about the economic slowdown and cut rates accordingly. So actually, this morning we received the news that that Germany turned into recession during the winter after the revised numbers. So in uncertain times, I would say that as a general rule, we should avoid making assumptions about the future as much as we can. And we have to try to create shareholder value by having a clear view on how the firm will react to each possible future scenarios. So what we can do on our end is to establish a set of good proxy metrics, which enable us to gauge our overall position, to run proper stress tests with different interest rate shocks, assess the impact of these stress events on the established metrics, and to really decide on our risk appetite. So when we have all these in place, I think we are in a pretty good shape to have a clear view on what our interest rate exposure is and what is the percentage of the risk that we would like to hedge. So in the current interest rate environment, I would highlight maybe three things. So one of them is securing a more stable and diversified funding pool than usual is really important to protect from the risk of bank runs. One other thing is that we should remember paying attention to the effect of the discount factor when we calculate the present value of our balance sheet. So this is something that was less relevant in the low interest rate environments, but this is now really hurting our net interest margins in the denominator. And last but not least, it's important to apply the same behavioral tenor for interest rate risk and liquidity management, which may sound obvious, but from what I've seen in several banks, this is not always the case.
Thank you, Julia. Laura, could you please share from your perspective?
Yeah, I'd say the first thing to start with is to create a policy with clearly defined objectives. Optimal fixed float mix can be different depending on some company drivers and some market drivers, which is why each company needs to define their own objectives. From a company perspective, the optimal level of fixed float debt mix can depend on risk appetite, as Adrian was mentioning earlier, how leveraged the company is, if there are covenants, the level of cash the company owns, if the company has the ability to pass through inflation, or if its activity is correlated to the economic cycle or not. Also, there are market drivers that need to be monitored. The absolute level of rates, the steepness of the curve, is it a good entry point to float more, to fix more, the expectations versus the current price. In terms of instruments, we do have the classical derivatives, interest rate swaps, options, swaptions. There are also derivatives that manage refinancing risk, hedging future issuance via forward starting swaps, treasury locks. One thing to remember is we can use the debt instruments to manage the interest rate risk, i.e. issue floating notes if you need more floating, or perform a liability management exercise to lock in attractive interest rates and take out the risk of your future refinancing volumes. This is in a nutshell my view on how we should be looking at managing interest rate risk.
Many thanks, Laura, for your insights. And now let's switch to even more complex topic about the impact of geopolitical and macroeconomic development on corporate liquidity. How do changes in global macroeconomic conditions, such as inflationary pressures or exchange rate volatility, affect corporate liquidity? And what steps can business take to adapt to these changes? Laura?
So inflation can have a double effect on companies' profit and cash flows. Firstly, an effect on the cost of inputs, raw material, labor. And secondly, the level of nominal interest rates is directly affected by inflation. We have recently witnessed the unitary effort of the central banks to hike rates. Therefore, naturally, this has added even more pressure on profits and cash flow via net finance cost, especially on the highly leveraged companies. Moreover, the interest rate differentials and the flight to safety have triggered volatility in FX too, increasing even more the pressure on liquidity. So as a reactive measure to manage liquidity, there are, of course, the measures that we've discussed, stressing liquidity, diversifying sources, but there are also a set of pre-event measures that could be taken. For example, having the right FX risk management strategy in place, or a commodities risk management framework. They do help. This program will give the time to the company to fund at the right time and at the right price. And companies that have these programs in place are more resilient and can maintain a competitive advantage for longer. This is what I would recommend for a company to protect against this type of shocks.
Well said, Laura. Thank you. Adrian, what do you think about this?
Yeah, so I think this question is really matching what happened to us in the last couple of years. So regarding the geopolitical, let's say, impact, trade disputes. So what we've learned is that we really need again to make sure we have. So I will go much more into the business side of the problem. We really have alternatives available. So let me give you some examples. We had some very important suppliers back in 2020, which were having their headquarters in the northern part of Italy. Guess where the pandemic broke out in Europe first. So we had some really big supply chain issues. So no raw materials, no alternative, no cash inflows, no potential to sell to our customers. So I think what this period taught us is to again try to shorten a bit the value chain, try to be closer to your potential suppliers, and yeah, be much more careful when choosing your partners. So sometimes, and I think this is a lesson that everybody learned during the last couple of years, because we were all kind of jumping mainly into the other geographies to absorb raw materials or other products that we were needing. So the trade disputes, the geopolitical instability showed us that in order to comfortably maintain our liquidity, we need to balance again the portfolio of our suppliers, and to manage much better the supply chain, which was really a big issue for us.
Thank you, Adrian. Thanks a lot for your insights. And Julia, what is your thoughts about it? You're on mute.
Sorry. So yes, in principle, the rising interest rates or the macroeconomic conditions should favor the banks, because it has a positive impact on the bank's profitability by increasing the net interest income of the bank. But on the other hand, yes, the geopolitical situation is posing challenges in the liquidity management, and I think that the extra buffer gained from the high interest rate environment should be used to prepare for covering a potentially higher challenge to find liquidity resources, especially in a setting where retail deposits are shrinking due to inflation, and this is especially true in the CEE region. Actually, in Hungary, I think 80% of the population does not have any savings anymore. So this is a dramatic number already. One of the ways to proactively manage the situation, I think, is to establish key risk indicators which can serve as early warnings. A possible framework for this is to monitor the metrics already required by the regulators, so such as the net stable funding ratio, the customer loan deposit portfolio, the liquidity coverage ratio, or the survival days. We can also add some other types of metrics, like the percentage of high quality liquidity assets compared to the entire balance sheet, or compared to the total deposits. or we can monitor the top 20 deposits compared to the total number of deposits. So once we have these key metrics in place, I think we can add the monitoring frequencies to them, and most importantly, to assign thresholds for these indicators, which will define the quality of the level of this indicator. So let's say we can put them in green if they meet a certain range. If they fall in another range, they will be yellow or red if they reach a critical value. And so this will give the institution a clear view on how long they can carry on business if they have no longer access to external sources of funds. And then we can determine the liquidity buffer accordingly. I think this is especially a powerful tool in uncertain environments without the necessity of making assumptions on the future, but actually it can also be very well used in less turbulent times. So I strongly recommend to have such a framework in place in every bank, and obviously not with the same metrics, but the principles could be applied in corporates as well.
Thank you, Julia. Thank you. And we have one more point. I have one more question on my list, but we are running out of time, so I would ask our panelists to be very quick if possible. For such a complex question, in what ways can treasury departments collaborate with other functional areas such as risk management or supply chain to effectively manage corporate liquidity in light of geopolitical and macroeconomic uncertainties?
Yeah, so if you don't mind, I would take this one and I would
please.
carry on with my previous previous framework in the previous question. So I think this key risk indicator system that I just mentioned is also efficient to embed the liquidity management strategy into the business. So we can report these metrics to the management, and so we can have an action plan approved by the management based on that, which can be shared across the organization and implemented in all the affected departments. Just to give an example, so if, for example, the loan to deposit ratio goes above 85%, the bank can launch, the business departments can launch a campaign to attract more customer deposits. So we can think about things like these. So in this way, I think the entire bank will have a viable balance sheet for the foreseeable future, and is secure to operate under any market conditions together with all the departments.
Thank you, Julia. Adrian?
Yeah, so I think somehow I addressed a bit part of this question in my previous answer. So I think a very strong cooperation now with the supply chain, procurement, or all these departments is key. We need to shorten a bit the value chain. We need to be really closer to our let's say geographies. And I think from this perspective, from a macro perspective, the region that we are part of, so CEE, is having like a huge potential on further developing because we have here all the relevant tools to take advantage of the current situation. So yeah, but a very, very strong cooperation with procurement and the supply chain, I think it's key in order to properly maintain and to keep under control the liquidity and the going concern of our businesses.
Thank you, Adrian. Laura?
From my perspective, communication is the key. I think all of the departments are involved in a part of the process. Finance and accounting need to communicate about the sensitivities in the exposures. So the sales need to communicate about the revenue and look at the pricing strategies. The risk management is looking to perform risk assessment, scenario analysis. The operation and the supply chain will look to optimize the capital management, the working capital management, inventory levels, payment terms, the collections. So to conclude, it takes a full orchestra to play a symphony.
Very well said. Thank you, Laura. Many thanks. With this, in closing, I would like to express my gratitude to our esteemed panelists, Laura, Adrian, and Julia, for their valuable insights and expertise in discussing liquidity optimization in times of economic slowdown. Their diverse perspectives have provided us with a comprehensive understanding of the impact of the global regulatory landscape and stress testing for liquidity, hedging strategies, and influence of geopolitical and macroeconomic developments on the corporate liquidity. I hope that the knowledge shared today will empower our audience to navigate liquidity challenges effectively and make informed decisions in uncertain times. Thank you all for joining us in this insightful discussion.